Friday, April 24th. I am often criticized for many things, more at home even than at work, but one of the professional criticisms of my copy near this video is that it's too negative, and I don't at all mean for it to be that way. I am a creature of the credit markets, as my dad and granddad. And in the credit markets, we deal with IOUs and whether or not you're going to get the payments and to whom to make the loan, and then always how the world looks outside, ready to get killed by the Fed or inflation or some other external shock. And so our tone of voice is very different from the stock market world. In the stock market world, it's always happy talk, happy talk, happy talk. If you watch CNBC or Bloomberg or any of the financial channels, it's a contest to see who can be the most optimistic. If there's a market crashing on the screen somewhere, the commentators do everything they can to avoid talking about it. And both of these attitudes are appropriate. In the stock market, there's always some minor group that sees the end of the world and is trying to warn you to build an ark or just leave. In the credit markets, the reverse is true, in which we always feel threatened by something, and the core of it, aside from IOUs and whether the guy's going to pay the money back, the core of it is, for us, bad news is good news. If the economy is soft, then the Fed's not coming, which is where we are today. The economic data stream has been distinctly on the soft side, which is theoretically bad news, but for us it's good news. And if we get good economic news, the economy's strong, then that means not only is the Fed coming, but we have to worry about things like inflation and other ways to lose money. And so I don't mean it that way. The copy beside this video points to that soft economic data and puzzles about why it is the way that it is. And there are two central pieces. One of them is that the drop in oil prices is clearly not as stimulative as everybody thought. And I think the answer is very clear. In all of the other oil price drop moments since oil prices began to jump in the early 1970s, natural gas and coal and electricity and home heating all followed right along. And so you had the whole energy complex making everybody feel better and leaving more money in checkbooks at the end of the month. In this excursion, it's just oil. Natural gas prices crashed 5 years ago, 6 years ago. So did coal, so did electricity. The second thing is the dollar, which I think the Fed misunderstood. It's easy to, that the devaluation of other nations against the dollar would have as much slowing pressure on the United States as it has had. But take it for that. We're sitting at 3.75, 30-year fixed rate money. The housing market is, to say that it's igniting is the wrong thing to say, except around here, local to Colorado. We're just doing better. We're doing gradually better. We're improving in numbers of sales 10-15% a year, and that's hard to complain about. Have a nice weekend.